Okay, hello everybody. Welcome to Korean Atlanta Mentorship, and in this video we're just going to do another velocity banking review. But before we get started, I just wanted to put a spotlight on this post that I put yesterday, where I put fill in the blank. Mortgages help homeowners reach the American dream, or lenders get rich. And 96% of you put lenders get rich. And then somebody wrote this comment here, which is kind of like the inspiration of the title of this video. And it's like, unless you Velocity Bank, that SHIT, I wish I knew this SHIT 20 years ago. Isn't that funny? Now, you know what's sad is that I kind of wish I knew it 20 years ago too, because I think I was raised with the scarcity mindset about money, even though I grew up in a rich neighborhood. And the reason that I think I was raised with that mindset is because I'm the youngest in my family. And anytime I asked for anything from my parents or my older brothers, they always acted like I was like being selfish for asking for things. I think that's what they call money trauma. I don't know if that's like the right definition, but if you have your debt paid off, it's like, bro, you can give your family members a 20 here, a 20 there, because it's like, okay, why is as a society we're okay with giving an extra 100 or $200,000 to the bank, but you don't give an extra $10, $20 to your family members. I remember every time I asked for like some money to kind of buy things, they'd act like, "Oh my goodness, like that's like the end of the world." Has anyone else ever felt like that? Well, it's okay. Oh, it's okay. I paid off my mortgage under 3 years, so but it's unfortunate that we have such a scarcity mindset. And by the way, if everybody had their debt paid off, I honestly think that people would be a lot friendlier. Believe it or not, every time I leave my house, every time I go into like some clothing store, retail stores, grocery stores, everybody is so unfriendly. And you want to know something? Okay, it's really crazy? A couple of days ago, I was at the grocery store and somebody asked me, like, is there something that you're looking for? And I was kind of shocked because that was like the first time in a long time someone had actually been proactive with me if I'm looking for something. And I was like, I really like that. That's something we've been missing for the past at least 4 to 5 years, which is kind of sad, right? But enough of me ranting. So let's get to velocity banking. So let me go ahead and switch gears. So, what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. And right here, 20 years, I put 20 years ago. This could have been you because this is me actually in 2024. So think about it. Let's say I knew this in 2004. Oh man, my parents probably could have been mortgage free by then because they'd been owning the home since 1993, 4. And it makes you wonder how banks are really patient and they're in it for the long run. Isn't that crazy? But 2024, I got the mortgage in 2021. So you subtract 30 here, and it's all paid off. And 20 years ago, if I'd known this, then maybe I wouldn't have like such issues with scarcity with money. You know, it's kind of sad. We all should have been here 20 years ago, but it's probably why nobody's like really friendly because everybody's so stressed. But story for another time. All right, so a little bit about me. I have tons and tons of credit, right? And credit is a tool, okay? Some people know how to use it wisely, most people don't, because there's a certain thing called the segregation of income effect that most people experience. And so, what is the segregation of income? Well, basically, you get paid, your expenses come out, right? So, take a look at this: three credit cards, two auto loans, and a mortgage. So, whenever you get paid, your income gets split kind of like in 5 ways, and then you just put the leftover in savings. So what we're going to do is that we're not going to segregate our income. We're actually going to put our income into one place, and the only way we can really achieve this is two things. Number one is we have the same income. Okay. Number two, zero savings, which is like, whoa, most people can't do that. And then we're going to do that with the help of a line of credit. Okay, with the help of a line of credit. So let me just kind of go start from step one. So what's this first step of velocity banking? Number one is doing a budget, right? So this is kind of like your debt payoff plan. You have your income, you have your expenses, you have your leftover savings, and then you have your expense breakdown. And so in your expense breakdown, you have every single debt that you have, and the whole point is to pay off your debt efficiently and as quick as possible. And the only way you can really do that is with having zero savings and dumping all of your money into your debt. Okay. And then last line here, food, gas, insurance, other. This is just all your general expenses that are not related to debt. That's step one. Step two is have a line of credit. Okay. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. Right. And I got tons and tons of lines of credit. In fact, I have over $527,000 in lines of credit. $527,000. And as you can see here, I have one line of credit that's 280, one that's 15. I got like 19 or 20 credit cards. I can't even remember, but I got a ton. And it's really important to understand how credit works because credit or banks are kind of like in the same game as insurance companies, right? So what they do is they're trying to mitigate their risk, but they kind of play the game a little bit differently, but they have the same goal, which is to mitigate the risk and make as much money as possible. So the way that they mitigate risk is to lend money to people who don't need it. And so most people they don't understand when they should go to a bank. And the reason that I know this is because I took these credit classes. I specifically took a class called Understanding Credit, and they taught me that, like, oh, banks don't lend money to people who need it, and I was like, oh, that's such a contrarian thing because you think, oh, don't you go to like a bank when you need money? Nope. In fact, I talked about this to a nurse that I'm kind of like, I don't want to say mentoring, but I'm just kind of showing her what I know, and she was like, "No, banks lend money to me to people we know." Like, nope, they don't. So just be aware of that. But my point is this: I have over $527,000 in lines of credit because I don't need the money. Okay, but if you're able to get a line of credit kind of like this, it's so cool because I'll tell you what the coolest thing is. Let's say you have a $50 bill due and you don't have any money. We'll just pull $50 from the line of credit and then put it back in. Bill satisfied. Nobody ever taught me that, right? Okay, so let's go ahead and do this. So we're going to assume same expenses, okay? And what we're going to do is have something called cash flow, which is almost like savings, except we haven't made our line of credit as our main operating account. And for the purposes of this example, let's just assume we have maybe like I don't know, a $60,000 or $65,000 line of credit, right? And let me actually $65,000 line of credit. It's like a credit card, but even a little bit better because you could use it to pay anything. Where it's a credit card, you can't use it to pay a credit card. You can't use it to pay a loan, right? But the line of credit, you just go to a bank's website, click a button, and then the money will come in. Okay. All right. So let's go ahead and do this and talk about milestones, right? Milestones. So now, okay. So I'm trying to think. So now what we're going to do is pay off all of our credit cards, and then we're going to write our milestones, how long it takes us to pay off our credit cards. So what we're going to do is shuffle those credit cards in a line of credit. Now, would most people have an open, empty line of credit available? Probably not. They probably have it filled to the brim. But let's just kind of imagine what if we had an open end line of credit. Now, the most important thing is you probably are not even going to get here if you'd known this strategy before you even took on debt. But again, let's just assume someone gave you a line of credit. Well, let's go ahead and move these three credit cards. So this is going to be 10, 20, 20. So it's going to be $53,000. $53,000. Okay. $53,000, and we just move some of that credit card debt, and guess what happens here? Whoa, our cash flow went from $900 to $2,700 in one swoop. And then the final step of this strategy is you put your entire paycheck, the entire 6,500, into the line of credit, and then you take your expenses out, and then you rinse and repeat the process over and over and over again. I'll show you how to do that with math, right? So this is I2 plus 1. The next one is G2 2 plus H2 minus whatever our cash flow is. And what's our cash flow? It's 2717.22. 2717.22. Okay. And now what we're going to do is take the interest, right? We're going to take the interest, base it on the average daily balance, right? Because that's what they take it on. And then we multiply it by the interest rate, 0.08, and then we divide by 12 because it's calculated monthly. And then all we got to do is copy and paste these formulas, okay? And look how easy that is. And let's see how long it takes for us to pay it off. Whoa, 21 months, so less than 2 years. That's pretty cool. So that's our milestone with the credit cards. Boy, I wish I know this 20 years ago, right? So let's just do this. So 21 months, and that'll be 53K, 53K, and then okay. So now we got to focus on these other loans. So how do you know which one to focus on? Well, I know from pretty much experience it's going to be probably auto loan 2. So auto loan 2 has the highest interest rate, the lowest balance, but it doesn't have the highest payment. But what it does do, it sucks up pretty much all the cash flow. So I'll tell you what I mean by that. So when we go to our loan calculator here, we got to just put what the current month is. So 21, 21, 21, right? And then you take a look here. There's this thing called the CFI, cash flow index. So all this basically means is like a ranking system, and anything below 50 you kind of want to pay off, and it gives you a significant amount of cash flow for paying it off. That's all that means, right? So what we do is we take these two loans. So actually we pay both of them off. So how much is this in total? So G2 plus G3. So that's going to be about 25 grand. All right, let's go ahead and do that. And no, this is the wrong spreadsheet. All right, so let me just go ahead and move these auto loans into here, right? So it's going to be plus 25444.77, okay? And then once we do that, and I know I'm kind of going fast here, guess what? We move these two auto loans into the line of credit, and whoa, take a look at this. This cash flow is about $3,445 a month, okay? So let's go ahead and do that here. All right, so I'm going to do that right here. And so now it's 3445.96. Okay. All right, so now I'm going to copy and paste here. All right, copy and paste here. And we see that in month 29, those two cars were paid off. So how many months did it take us to pay off two cars? 1, 2, 3, 4, 5, 6, 7, 8. Isn't a car loan supposed to be like 5 to 7 years, but we paid off two in 8 months? Whoa, my mind is pretty blown. Okay. All right. So 29 months, and then now it's, let's see, 53 plus 20 plus 17, and then that'll be 90K. Okay, so 90K. Good deal. And now this is the one that people get obsessed about with their mortgage because it's tied to their home. But really, like, the mortgage is the one you want to pay off less. And why is that? It's because no sane person would, let's say, give someone $250,000 only get $1,000 back, right? But the reason why a bank would do that is because they're in it for the long haul, right? They're in it for the long haul to get the interest, but most people would not do that. So we have to think in terms of cash flow. Hopefully that makes sense. But my thing is this, okay? So unlike these two auto loans where I could dump it into a line of credit, I'm not going to dump a mortgage into a line of credit because there's not enough cash flow to offset those interest rates. Okay? So what we do here is we can do two things. Number one, dump the cash flow directly into the loan as an extra payment, meaning we still make our monthly payment, and then on top of that we add the $3,445. Or what we can do is just move some of the principal into a line of credit and just do what we've always been doing, which is pay it off with our cash flow, do it over and over again. Now, you might be saying, well, would I do it that way if we're dealing with a higher interest rate line of credit? And the reason why is so that we don't segregate our income, because segregation of income is how we got here in the first place, right? So something to think about, but you could do it either way. And so we could just do maybe how much, but $7,000 chunks. So let me just kind of go here to our loan calculator, and this is like 29 months now. I think this is 29 months. Yeah. So this is now 0. This is now 0. So how much of the loan have we paid off? So 250 minus 237. Okay. So 250 minus 237. Whoopsie. Okay, so that's about 13K, okay? So this 13K, well, let me write it like this. 13K to 29 months, okay? This 13K took about 29 months to pay off. Now, let's just move this 13K into the line of credit. So plus 13000, okay? And I think, yeah, the cash flow is going to stay the same. But take a look at this, right? 1, 2, 3, 4, 5. So something that took us 29 months, we're able to do in 5. And then we just rinse and repeat over and over again. Now, I don't need to use a big chunk. We could just use a smaller chunk, just as long as our cash flow is what it is. It's maximized, especially with the mortgage. But the most important thing you'll learn from this is you don't have to put your line of credit inside a mortgage. In fact, let's go ahead and whip out that velocity banking calculator. Give me one moment. So let me just take a look right here. Oh boy, I'm so sleepy, but it's okay. I gotta be strong for you, for YouTube's. I'm not even saying YouTube right. I'm saying YouTube's. Anyways, so let's go ahead and see if I put in the numbers correct on this velocity banking calculator. Is it 237,113.3? So let me just do that. 237,113.3. Okay, that's the current balance. And then what is my 6,500, $2,000, and then take a look at this, right? Whoa, 4.8 years. Now the moral of the story is, like, even if you just kind of increase the chunk to like 10,000, it kind of increases it, but it doesn't. The amount of interest we pay, but it doesn't really matter. But ideally, you just take a small amount. So just like $7,000 should be fine. Now, okay, so let's think about this. The more that let's say we replace the mortgage with the line of credit. Oh my goodness. We pay all this unnecessary interest, even though it's paid like $50,000 saved is pretty good. But why go 50,000 when you can do 18,000 and then pay it off in 4.8 years, right? Isn't that crazy? Shout outs to Renatus and their velocity banking calculator, which is where I learned velocity banking from. Okay, so let me just kind of go ahead and put that in the other thingamajigger for I can't even think straight because like I'm so sleepy right now. But let's go here and not here. So now this one is 29 divided by 12 plus 4.8. Okay, so that's 7.22 years, right? 7.22 years, and then 360K debt free, and then now this is 0, and then we're good. That's it. This is where we're at. And here's the cool thing, right? If we known this 20 years ago, like I said, we could have been in rich people problemville a long time ago. Because I'm going to tell you something. No matter what stage you are in life, you're going to have problems. But would you rather have rich people problems or poor people problems? The difference between rich people problems and poor people problems is that when you're poor and you have poor people problems, you find it very hard to go to sleep at night and you get stressed waking up. Whereas if you have rich people problems, kind of like this right here, where it's like, oh my goodness, you have too much available credit. That's why we can't give you another credit card. You can kind of go to sleep at night, but although it's kind of annoying. So again, what if you had paid off your mortgage 20 years ago? What if everybody did? Maybe the banks wouldn't have the tallest buildings in North America. Maybe the second tallest or the middle buildings is good enough, right? But yeah. Yeah, so that's it for today. Velocity banking, I don't even know what tab I'm so sleepy, but it's all good. 7.22 years to be $360,000 debt free. Should go to sleep. Good night. Sweet dreams. This is Karina Lanta Mentorship.